10-year note yields continue the push lower, actually having the lowest weekly settle going back to September of 2018. And on that week when they settled in September of 2018, the low print was low settle was 205, and that was today's low yield mark. So right now the market's just kind of waiting for that next bit of news that's either going to push us below 2% or retrace us back up higher, albeit at a much slower rate. And I think at this point, the demand for bonds, the demand that we're seeing and the urgency that we continue to see it isn't going away anytime soon. And you can blame it on headline news. You can talk about economic data in the States. You can talk about the Fed. But this has been going on now since March, and it continues to push, despite the fact that we've now seen maybe a sideways trade for the last couple of sessions. Don't be fooled that this can't continue to go lower, because as long as we continue to see buyers step up the way we have over this last week, that 2% won't last very long. And right now, hovering around 208, where we settled this week, that 2% level is well within striking distance. And if you look at volatility, earlier this week we hit year-to-date highs nearing 5% in the 10-year bucket. We did back off of that over the last two sessions pretty significantly, but we remained above the 14-day moving average, which is key because that's a level we haven't traded below in volatility, say, going back to the early first week of May. So volatility's been firming, has been staying elevated, remained bid as yields continue to push lower, so that even though we're still trading into that trend, we're starting to find more areas of breakouts. So if we get below 2%, expect volatility to really find a much better bid than we saw in the last couple days. We're not quite there yet, but as we go into the weekend, things remain on a yearly or go back over the last 10 years remain very elevated in volatility as yields are going lower. And lastly, let's talk about the Fed and their upcoming rate cuts, because it's not if, but it's when. And right now the market's really pricing in a 25 basis point rate cut at the July meeting and then possibly another 25 at the September meeting. That's 50 basis points of cut with possibly another one coming in December. So the Fed could be a little more aggressive if the numbers aren't as pleasing. Today's non-farm payroll number obviously didn't really help the Fed's chances of being patient with their rate cuts. Likewise, we get some good news out of the trade Trump talks, whether it be with Mexico and China. There is some positivity there, which has elevated stocks, but certainly doesn't change the fact that the GDP now numbers are still showing sub 2% growth, or expecting sub 2% growth for the quarter. And I think at this point, the Fed is on pace to either cut 25 or 50 at the July meeting, and then kind of a wait and see what happens. Do they need to go again in SEP, or can they wait until December? But the market is firmly priced for almost 75 basis points of cuts in calendar year 2019. And that probably is the biggest news of the week, other than the fact that 10-year note yields continue to be pushed lower. So heading into the weekend, plenty of demand still out there for those 10-year note yields as we hover just above 2%.